Hello and welcome to BQ Prime. You're watching IPO Adda, and the company in focus today is Yatra Online. It's a company which we all use on a daily for intercity or domestic travel. The company is coming out with an IPO which is opening on September 15th, closes on 20th of September. Price between 135 to 142 per share. It has a fresh issue of 602 crores, and there's an OFS component of 173 crores, taking the total size to 775 crores. And joining me today is Dhruv Shringi, who is the whole-time director and the CEO of the company. Dhruv, thank you very much for joining us on BQ Prime. Give me a sense of the 602 crores which you're raising in fresh capital. How is it going to be used?
Firstly, good morning and thank you for having me here. It's my pleasure to be here on your platform. In terms of the use of proceeds that we are looking at, so for the 602 crores that we are looking at raising, there are largely two key buckets within which this will get deployed, and this will get deployed over the course of the next 3 years. The first bucket is on growth initiatives, which are largely organic in nature. This will focus on customer acquisition, driving the business deeper into tier 2, tier 3 markets as travel becomes more and more pervasive across the country. And you see more and more airports being opened up in tier 2, tier 3 markets, and expansion in the current metros in terms of airport capacity. So one area would be organic growth initiatives for our consumer business and likewise for our business travel business. So these are two areas where we are, extremely gung-ho about the growth opportunities. The overall market is expanding very strongly. And as a market leader in the corporate travel space, especially the technology-enabled corporate travel space, we want to go deeper into the market using our technology solution. So the larger chunk of the capital that we are raising will be focused towards organic growth. And then the second part of it, which is there, will be towards M&A. So we've set aside about 150 crores for M&A. We've successfully done some acquisitions in the past, and these have been in the nature of business travel companies that we've acquired. These are companies typically with a strong customer base, but maybe limited amount of technology capabilities. So our endeavor is to acquire these entities, put in technology, and significantly improve the operating margins of these businesses. So that's the other avenue that we are looking at from a growth standpoint.
Before I come to the use of proceeds a little more and try to get more color on it, you have a holding company, Yatra Inc., which is listed on the NASDAQ OTC platform, if I'm not wrong. What is the kind of relationship that you have with that, and how much promoters hold in that company, and who are the other big holders of that company?
Sure. So it's listed on the main exchange, not the OTC,
Okay.
In the NASDAQ, right? The main holders over there are largely institutional funds, and the combined holding of institutional funds plus retail will be close to about 85% over there, with 15% being held approximately on a fully diluted basis by the management team and employees.
And of late, you have entered into some agreements with Mac Capital, which owns nearly 19%. Can you give us an idea of what kind of capital agreements that you have entered into?
Sure. So Mac has been a long-standing shareholder and supporter of Yatra, and they will continue to, we hope they will continue to be so for the long run as well. They've been on our board right now, and they've been on the board for over a year. We've entered into an agreement with them whereby they will continue to be on the board for the next couple of years.
And is there a financing or debt financing agreement with Mac for Yatra?
There was one at the holdco level, and that will come to fruition. That debt is due on the 5th of October.
Okay. So you
But
will
that's
be
the holdco level. So part of the proceeds of the OFS will be used to repay that.
okay. So the promoters had taken the debt. That's or the holding companies have taken the debt, and that will be
The
repaid.
holding company.
Okay.
That is right. The holdco had taken the debt, and that will just get repaid from the OFS. So one part of the OFS of 173 crores will go towards repayment of that debt.
Okay. Use of proceeds, you said 150 crores for acquisition and M&A. What kind of opportunity that you see, because you are a technology platform as well? You've seen in that valuations of many of the tech platforms are very high. Is it building up a better option than buying out, or if the acquisition happens, it's only for a customer acquisition point of view?
So what we look at is, we are looking at two things. One, in terms of what is the opportunity for us to improve the performance of the entity that we are acquiring, and two, does it offer a significant cross-sell opportunity for us? So more than the raw price, it's about what incremental return can we drive from that acquisition is what we are focused on. And like we've done this successfully in the past, we would be looking at acquiring these entities and then putting in place our technology solution to thereby drive operating margins significantly higher. That would be our endeavor. Or the other opportunity that we are looking at is, option for products that can be cross-sold into our large corporate customer base. So that would be the other opportunity that we would explore. But these have to be highly synergistic in nature. We are not going to be looking at doing something which is completely unrelated to what we do.
Hmm. Um, Before I come to that business, B2B business that is growing very fast for you, customer acquisition and retention, you are using 392 crores from the IPO. If I see the cost that you are putting in for acquiring a customer, that's been increasing every year. Uh, just to give a perspective, from 226 crores in FY21, it has gone to 456. I'm talking about the airline ticketing part here. It has
Yeah.
gone up to roughly, it's nearly doubled in 2 years. What is happening in this sector, and is this going to continue going forward?
So I think you should look at that in the context of the revenue growth as well, and in terms of the growth in passenger numbers. And on those models and metrics, you will see that the jump is not as stark as it looks out here, just comparing the absolute number. See, our business also has almost doubled year over year. Our gross bookings went from, I think, about 3,300 odd crores to almost 6,800 crores between 2021 and 2023. Right? So there's been a meaningful growth happening in the numbers and the business as well. So in percentage terms, we continue to see good operating leverage. In fact, our profitability has also at the EBITDA level. So if I look at adjusted EBITDA as a metric, it's gone from like 33 crores to almost 67 crores in FY23. So we are seeing bottom line also almost doubling in line with the spend that's happening. So spend is just one part of it. It's about the revenue growth that we are able to drive from that spend.
Dhruv, you spoke about the adjusted margin here. When you calculate your revenue, you remove that cost of acquisition while recognizing your revenues. In adjusted margin, you add back the cost of acquisition. Now, the cost of acquisition is going up, and you are using that as a metrics. Is there a timeline or path or glide path for you to say that this is going to be the maximum cost of acquisition that a company would be putting on? Because while you said that there is an exponential growth in revenues coming in, and so is the EBITDA coming in, your EBITDA margins have are at 7% or so. I'm talking from a core EBITDA margin and not the adjusted one. So it's 9.6% if I'm not wrong. That's EBITDA margin. So I'm talking from a point of view cash burn that is happening at your end, and how long will it take for you to stabilize that cost of acquisition price going forward?
So just to also just maybe throw some more color on that, right? Firstly, from a cash burn point of view, at the operating level, we are free cash flow positive, right? So we are not burning any cash. That's one of the things which is different about us. So we are not consuming any cash. Whatever cash consumption is happening at the overall level, it's towards working capital to facilitate growth on our corporate business. But at the operating level, we are cash flow positive, right? And I mean truly cash flow positive, not on some adjusted measure, right?
But your
So
cash flows
that's
from operations were negative in FY23.
because of the working
Only
capital.
cash flow from
Yeah.
financing was positive.
So that's because of the working capital, right? So the working capital deployed. If you see our corporate business from the previous year would have more than almost doubled, and the corporate business has about 28 days of DSO. So with that spike in and growth in corporate business, there is incremental working capital which is being deployed. Once the growth rate, I don't think we'll maintain a 100% growth rate. Once the growth rate stabilizes to a 20-25% kind of growth rate, right, which should happen over the course of the next couple of years, we will then start seeing the cash flow generated from operations being more than sufficient to take care of the incremental working capital needs. Here, it's been a slightly different scenario because you're coming from a low base of COVID, right? As you would recall, in FY22, a significant part was impacted by COVID. So corporate travel was at a very low ebb. But in the second half of 2023, we've seen very strong recovery happening in corporate travel. So that's where you see the jump in working capital utilization happening.
So, give me a sense at the current run rate that you have, uh, your cash flows from operations, when will it turn positive?
So we think, from a cash flow from operations point of view, and we are delving a bit into future-looking statements out here, right? So with
Yeah.
that, do caveat that these are,
But you have a game plan in place, right? So that cash flow from operations, start looking positive from here.
yes. So in the, relatively near term, right, we should be looking at a scenario where cash flow from operations also will end up being positive, right? So that's what we are working towards. As I said, this has been largely a working capital requirement, which has this scenario, right, on the back of the growth. So it's a good problem to have, right? Your business is growing very rapidly and you're deploying working capital for that. So it's not a case where you're spending more than what you're earning.
So nearly
So, but we
28.
expect.
So nearly 28% is coming from B2B today, right? Corporates, which of your revenues. How do you see that segment growing going forward?
Yeah, so we expect, if I look at, a pre-COVID kind of number, pre-COVID, our business mix was roughly half and half between B2C and B2B, right? So we expect, corporate recovery to continue to be strong. We've seen this happen in the second half of FY23, and we see that momentum continue to carry forward. So my sense is over the course of the next, year or so, we will again get back to a 50-50 kind of setup between B2B and B2C.
That's interesting because that will give more stability on revenues for you going forward as well. Give me a
And
sense of
yeah.
give me a sense of the revenue flow. Uh, is your operation dependent on seasonality there or big events coming in? And which are the quarters that, from a investor's point of view, you should be looking at, because if there is there a volatility in the revenues that that we are talking about?
Sure. No, that's a good point. So travel industry is slightly seasonal in nature. And if I look at both of our businesses, they do have a slightly different seasonality. So the B2C business will have a strong April, May, June, and then a strong October, November, December. Corporate, again, typically corporates will have new budgets which will come into place from April. So April, May, June will be strong. October, November, December will be a bit weaker because you'll have the Dashera and Diwali holidays and then Christmas holidays, right? So you lose almost 30 days in holidays in that quarter. So that would be typically a weaker quarter for the corporate business. And overall for the industry and overall for both our businesses combined, you will typically have the July to September quarter being the overall weakest quarter. That's typically when people are coming back from summer vacations, right? There isn't that much travel happening. You've also got disruptions happening on account of rains and monsoon in India. So flight disruption is at its peak during the month of July. So that would seasonally be the lowest quarter.
So the revenue recognition for air tickets happens at the time of booking or at the time of utilization?
It's at the time of issuance of ticket.
Okay. So,
right. So typically what will happen on the domestic side is the lag between booking and travel is not that long, right? And on international, there might be a bit more of a lag. Domestic will largely happen within a 30-day window.
Okay. So give me a sense of how you're planning to increase your international presence as well.
Sure. So in terms of international presence, the first step that we've taken towards that is to have partnerships in the Middle East and in Africa. Other emerging markets have exhibited attributes which are very similar to what we are seeing in India. We are seeing strong adoption of technology post-COVID that's happening in these markets as well. So we have a tie-up with one of the largest companies in the Middle East, and this company is using our technology solution and will be using that going forward to service its customers in the Middle East. And the same is a partnership in Africa. These are still relatively early days for these partnerships, but we are quite hopeful that these will continue to be, strong revenue generators for us and also provide us an opportunity for further growth into these markets.
How do you plan to penetrate the tier 2 and tier 3 markets? Because that's something which you haven't penetrated much, because you are there in tier 1 metros, big cities, everywhere you are there. Tier 2 and tier 3 is not there. So if I were to ask you that, what portion of your revenues today come from tier 2 and tier 3, and how do you want to increase that revenue? What would be the answer?
Sure. So in terms of percentage of revenue on the consumer side coming from tier 2, tier 3 markets, you're right that the vast majority of our revenue will come from the top 10 cities, right? That's what the current mix is. We're looking at a hybrid model going into tier 2, tier 3 cities. We are looking at a agency network that we have of partners. We have almost 30,000 partners who've worked with us over the course of the last 5-7 years. So we will use that partnership network to expand deeper into tier 2, tier 3 markets. We are seeing a scenario right now that in these markets you can continue to see new airport development happening. Airlines are also launching new flights. So we are working closely with the airlines as well on the new routes that they put forth, and we partner with them to try and promote and generate demand on these new routes. So it's a combination of using our distribution network that we have of partner agents, and then on the other side, working with the airlines to create some special value proposition on these new routes.
Give me a sense of how big events like G20 and the World Cup means impacts a company like you. We had the G20 which was spread all over the country, so it's got over the last weekend. But a World Cup which is coming up and top 10 cities where it is there, what is the kind of demand that you're seeing? How does it impact a company like you?
So the G20 should have a good long-term positive benefit in terms of customers coming into India. See, India as a destination has obviously suffered a bit in the last maybe 3-4 years. I think the G20 has really put a new benchmark in terms of people's perception of India. I think it has, at least the initial conversations we've been having with our partners in different parts of the world, it has really raised India's profile as a destination. And I think on the back of that, we should see international foreign travelers coming into India going up quite meaningfully over the course of the next few years. So there I'm quite gung-ho on the inbound business. The inbound business, as I said, has been suffering for the last 3-4 years, first because of COVID, then on account of a general slowdown in Europe. But seeing what the G20 has done in terms of raising India's profile, I'm very optimistic that inbound travel will pick up in the coming years. In terms of the World Cup is a great flip from a domestic travel perspective. We've already seen really high demand happening for both hotels and for flights into the places where there are key matches that are happening. So that definitely is a huge boost to domestic tourism at this point.
How does it impact
I
you?
think the only challenge which is there is that supply is running out very quickly. So you constantly are getting into a scenario where people are reaching out to you, friends, family, everyone's reaching out to you saying, can you help us get a hotel? Or can you get me a cheaper flight into some of these places?
So, do you have this flexibility of pricing the airline ticket during these big events? Because you are based on an inventory model, right? You buy the tickets and then you sell it off.
See, we do very limited amount of inventory buying. That will typically happen during periods of scarcity. But at a time like this, we don't want to look at this from a profiteering point of view, right? So we are not engaging in any inventory buying. The pricing is set by the airline itself in terms of what price the airline wants to price the ticket as. So we are doing this as a pass-through only, as opposed to doing any markup from our side. I think it's a great event. This is the time to really grow volumes, as opposed to looking at this as a short-term opportunity to profit from it.
Give me a sense of, we've seen consolidation of GDS happening in the market. Air India has already done it, and I think 2-3 years back, 2018, if I'm not wrong, they have done it. How do you see that as a potential risk going forward, and how does it impact a company like you?
I think Air India did experiment with going to a single GDS and look at GDS consolidation. My sense is, and we've seen some press releases to this effect as well, that they will move into a multi-GDS platform in the relatively near term. I think everyone realizes they need large distribution. See, we are in a situation in India where there is tremendous amount of incremental supply coming. We have less than 700 aircrafts that are operating at the moment. You have almost 2x of that number more in terms of new demand or that the airlines have put forth with the aircraft manufacturers. So we will see a tremendous amount of incremental capacity coming in. And on the back of that incremental capacity coming in, the airlines need all the distribution help and support that they can get. So I don't see this to be a time where people will start narrowing down their distribution channel. I, in fact, see this as a time when people will look at expanding their distribution so that they can get as large a share of the pie as they can. See, from an airline's perspective as well, if they have so much incremental capacity, they also need to deploy, right, this capacity. They can't just have it sitting idle, right? They need to drive plane load factors as well for them. So I see this as a market which will grow and expand from a distribution perspective as opposed to contract.
Uh, you know, one of the biggest risk for you is airlines going into insolvency. We saw Jet going in and then followed by Go Air. What is the kind of dues that outstanding that these airlines owe Yatra, and how do you plan to recover that part of it?
So with Jet, obviously there was a bigger setback, right, when Jet went under. But I think we've learned our lessons from there. And if you look at the Go Air scenario, our exposure to Go Air is 3.9 crores, which is, if you look at our peers, you would find this to be significantly lower than any of our peers. I'm talking about, 5 to 10% of the exposure levels that our peers will have. So we've been very cautious in this. We've been very careful in terms of how we take on some of this supplier risk, and we've seen that pay off for us.
So it was
I think,
an involuntary insolvency for Go Air, and they're now planning to come back into operation. So is there any plan that you have in place? How you plan to treat airline, the risk which is involved with that airline? How does the company deal with such a thing?
yeah. So, we've taken the view that there is a calculated risk that we will take based on the airline and based on, what other market feedback we have. We look closely at factors like, is the airline paying statutory dues on time? Is the airline paying salaries on time? Are there delays to other vendor payments in the industry? And based on that, we decide from a risk management policy perspective how much exposure we want to take onto the airline. And this has worked out well for us in the last few years. So we've taken a carefully calibrated approach to the risk that we have when it comes to working with airline partners, and we will continue to do so. I think there will be short-term opportunities that people will try and exploit, but I think we are here for the very long term. We are not looking at this as one quarter and saying, here is an airline on whom in one quarter I can make some money if I take an extra amount of risk. We will continue to do this in a judicious manner for the long run.
Uh, and how are you going to deal with Go Air once it comes back or once it attempts to come back?
See, as of today, we filed our claim in NCLT for the dues that we have from Go Air. There are conversations which are going on. We are hoping that, and we would like for Go to come back, right? This is such a buoyant market. There is such high demand in the overall ecosystem. So it's a shame to see an airline go under. Obviously, Go has had the misfortune when it comes to the engines and being able to get the engine recovery done from the engine manufacturers. But that's a different story. But from our perspective, we would love to see Go Air being back in the air. And as long as we can come to the right agreement in terms of past dues, we'd be happy to continue to work with Go Air.
My final question is in the hotel segment, which you recently you acquired some of the properties in this segment. How is it doing? How do you plan to increase the number of properties into it, and what kind of demand you see in this segment? Because if I look at customer acquisition cost, this segment has seen costs coming down year on year. So how is it working?
So on the hotels, actually, we've got one of the largest supplies in the country. We've got over 100,000 hotels on our platform, and the hotels have been doing really well. During COVID, there was obviously a lack of new supply coming into the market on the hotel front, and we've now started seeing, after that gap of about 2.5 years, new supply beginning to come in. So the demand has been extremely robust, and on the back of that extremely robust demand and high ARRs, we are seeing new entrants coming into the market, bringing on more supply. So hotels demand should continue to remain very robust, and the business should continue to do well. We are also seeing strong attach rate happening on the corporate travel side of employees when they're traveling, booking their hotels also in addition to their flights. Because as you see from a pricing point of view, if prices are high, people know that getting last minute inventory is going to be a challenge. So they are using the platform to pre-book hotels also. So that's giving a good incremental revenue and at a much lower cost of acquisition for the hotels business.
How has the World Cup helped you in this?
See, World Cup obviously is helping in terms of driving demand. People are beginning to look and book early, knowing that this is happening, but prices already have started going up. So if you are in the market trying to find a hotel for the World Cup, I think you might be a bit too late for some of the key games.
I think no one should look at Ahmedabad because you won't get one.
Yeah. I think you
Dhruv,
need to be prepared to drive 4 or 5 hours into Ahmedabad, and even then, supply is limited.
that's true. Dhruv, it was a pleasure talking to you today on BQ Prime. Your IPO is opening on September 15th, closes on 20th, price between 135 to 142. It's a 602 crores fresh issue and 173 crores of OFS. Thank you for watching IPO Adda.
Thank you for your time today.